We're talking about different kinds of bank accounts, and this presentation builds on top of the previous presentation about what is a bank. So I would suggest that you actually study that first and then go into this one. So the main argument is that a bank is an intermediary between the people who have money and the people who need money. So the people who have money, they have it for different time periods. Some of them don't need it for a long time. I mean, they have the money, they just don't need it now. They're just saving for retirement or college or some big expense in the future. Um, some people just they have the money, they just don't need it for a few years, but then they will need it. But for now, they don't. And then some people just have some money and then they need it for more immediate needs. And obviously, the same person can have different, allocations of their own money for different maturities, different durations. And then the people who actually need money. So we need money for buying a house, 30-year mortgage, buying a car, or something shorter, about a year, home improvement and such. And then we just need money for making ends meet until the paycheck comes in, right? So the job of a bank is to intermediate between the people who have money and the people who need money. But the problem is that the people will always, well, most of the time, will need money for a long period of time. And then when they have money, they want to have the money immediately, or they want to have an access to the money immediately. So the banks need to know how often depositors will need their money back. Remember, they're giving their money on a mortgage, 30 years, on a car payment, 5 years, on a home improvement, 2 years. But then the money comes from, you know, people who simply don't want to part with their money. They want to have access to their money immediately. So the challenge for a bank is how do you actually get these money and then give them to 30-year mortgages, right? So they need to know how often depositors will need their money back. And this is where the different account types come in. Remember, banks offer a service, and their service is to intermediate between the borrowers and the lenders, right? Lenders are the people who have money, they're just giving it to the bank for a safekeep, and the borrowers are the people who need money. So we have three types of accounts that are most common. The first type is a checking. A checking account gives immediate access to money, and a savings, quick access with minor limitations, very similar to checking, but not exactly. And a certificate of deposit, CD in short, in which case the money is not available for a certain period of time. I've seen CDs that are 10 years maturity, and you really cannot touch your money for that 10 years. And if you wanted to, or if you really insist, you could, but you would pay significant, severe penalties just to be able to get your money back. And those penalties could be 10% of the money, 20% of the money, may not even have to do with interest. You could actually lose a portion of your principal just to get your money back early. So, a checking account, you have an immediate access to your money. You could deposit or withdraw money very quickly. You could just go into a branch and get all your money out. That's it. Or if you have, additional funds that you want to deposit, you could just go into the bank and into the branch and then deposit your money. You could use a debit card. It's a plastic debit card that you could simply go to Walmart, you know, go through the POS machine, make a payment directly from your checking account. You could go to an ATM machine and withdraw money immediately. So you have immediate access as if the money is on you. You can write a check, although writing a check is not the safest means of making a payment, but still, you could write a check. So much so that you could write a check and to the order of, you could write it as cash, and then that piece of paper becomes as good as cash, right? And I'll go to that in a minute. But that check allows you to have access to that money in the checking account immediately. It is a service account for banks, which means that they actually charge a fee And this fee is waived for certain circumstances. You have X amount of dollars in the account, you're a student, you're young. This is a bank that's specific to some group, like a credit union, like we have at Loyola and Tulane. Like there's one at UNO, and some retirement accounts have credit unions. Uh, Military personnel have credit unions, and so on and so forth. So these type of institutions may waive fees for checking accounts, but most of the financial institutions will have some sort of a fee associated with checking accounts. Remember, they don't really get much out of it. They're just providing you a safe place to keep your money, and they're giving you access to their technology. And therefore, when you deposit your money with them, you have access to your money, and you lower the amount of risk you're facing by keeping your money at that institution, and you're making it a lot more convenient to have a use for your money. Most banks will not pay you interest for the checking. I have seen some they do, but pennies. Um, so you shouldn't consider this account to be an interest-paying account, none whatsoever. And it may be vulnerable to fraud. I mean, think about it. You actually have a debit card attached to a checking account, and a check that you're writing connected to this account. So this account is incredibly vulnerable to fraud, theft, and so on and so forth. So, um, and you should also know that while I will talk about this in different presentations about credit cards, but while a credit card might offer you certain insurance products that go along with the Visa or the MasterCard, your checking account does not have these protections. You are at the mercy of the financial institution that you have an account with. And if your identity is stolen and somebody logs into your account, withdraws your money, wires your money, there's very little you can do about it. And most of the time, you may be directed just to call the police and file a criminal report, and then the likelihood of you getting your money back is very slim. So you should be very careful about how much money you keep in a checking account, and then you should be very careful about who you write a check to and where you use your debit card. Using your debit card online is very bad idea. Using your debit card in a lot of places is a very bad idea. That's why we have credit cards with limits that are low enough, and so on and so forth. So we'll talk about that at different presentations, but you should know that checking account are ultimately vulnerable to fraud, theft, and etc. So you should not have a whole lot of money in your checking account. So what is a check? A check is a payment order. It simply is a piece of paper, like so, and it has pay to the order off, and it has a date, and then it has your however much that you're going to pay, and then you write it in actual writing, and then you sign it. But notice it actually has your personal bank information. So I see these people who write checks at Walmart counters be thinking that a credit card or a debit card is really not safe. They don't realize that by just writing that check, you're giving that person and that company your name, your home address, your account number, your bank's detailed information, and a copy of your personal signature in one paper. And for a few dollar of a payment, you basically just give up all that information to that company, to that person. Um, so it really is not a good idea. A check allows a person to withdraw money from your checking account. Basically, you're saying that person ABC can have this much from my account. It's a payment order. So the person actually takes this to a bank or takes this to another bank, endorses the check, the back of it, and signs his or her name, and then gets the cash. But a security is a serious issue with personal check. Check kiting is a federal offense. Uh, I mean, it's an offense at the state and federal levels, and it really is a serious offense. Every day we hear people who actually become victims of check fraud, and so you should be very careful about owning checks, safekeeping checks, writing checks, and you should be careful about who you write checks to. And it really should not be the main form of payment for you. Um, I see people who actually write checks to, you know, for little of things, and for $2, they basically hand out like a tip to somebody. They just hand out a personal check, and I just can't believe how, um, yeah. So this is a check, but like I said, a personal check is ultimately vulnerable to um, security issues. So you should be very careful about it. A savings account is a layer um, safer than a checking, just a little bit more safer than a checking account. You still have immediate access to your money, right? So remember, with a checking account, you have immediate access to your money. You could go to an ATM, withdraw your money. You could write a check, withdraw your money. You could go to the branch, withdraw your money. Um, it is a service account, and the banks don't pay interest. They may charge fees, although those fees may be waived. A savings account is very similar. You still have immediate access to your money, but there may be some limitations. Like, for instance, some banks may say you could only withdraw 3 times a year, 3 times a month. You could only withdraw 5 times a month, and you could withdraw only half the money, and that sort of thing. Otherwise, you start paying fees. You could deposit or withdraw money quickly. You could just close the account, get all your money out very quickly, same day, immediately. So it's very similar to a checking account. You could actually use a debit card and connect a savings account to a debit card, but that kind of beats the purpose. Then that really turns your savings account into a checking account, and then you just really lose that layer of security that you have in a savings account. It still is a service account, and the banks usually charge fees for having savings account. You're basically giving up your money to the institution for safekeeping, and for that safekeeping, they charge you a fee. Uh, like the checking accounts, those fees may be waived, and the banks pay very little interest. Still a little higher than a checking, but still very, very little, if any. And it may be vulnerable to fraud, theft, etc., relatively less so than the checking accounts. The only thing that actually makes a savings account slightly less risky, less vulnerable to fraud and theft and identity theft and all of that, is because you're not writing a check against it. See, when you write a check, you're giving up your account number to a person you're giving the check to. Since you're not writing a check against the savings account, well, your savings account number is not as public as your checking account number. And therefore, it is slightly less vulnerable to security issues. Certificate of deposit. Well, a certificate of deposit is a time deposit. It is like a savings account, but they're open for a duration: 3 months, 6 months, 6 years, 10 years. They do pay interest, very low, but they do pay interest. However, you cannot access your money for that duration. Meaning, if you have a CD, in fact, banks don't use you open a CD account. They say you're buying a CD, right? So, which actually implies that you're buying a product and you can't back away from it. You can't get your money back. And if you want your money back, you pay a huge penalty. A lot of the times, that penalty will be high enough to uh, to make you think again, and a lot of times to walk away from it. It still may be vulnerable to fraud and theft, but since the money is locked up, even you can't touch the money a lot of the times. But you still have to be very careful because, if your identity is stolen and you're a victim of fraud or theft, the people who actually steal your identity won't care how much penalty that they pay with your money. So these types of accounts may be vulnerable to fraud because we, as clients, may not be checking on these accounts as often as we should, because we're thinking it's a 5 year account. Even I can't get the money. Well, the people who actually steal your identity can, and they don't care about how much penalty that they pay. It's your money. And therefore, our likelihood of neglect may expose these accounts to fraud and theft and etc. So certificate of deposits are time deposits. we lose immediate access to the account, and they're really not convenient, and they're not products of service. They're products of the bank is offering you a little bit return, interest. They're renting your money for a period of time. So there is the issue of deposit insurance, and there are some misconceptions about it. The deposit insurance is offered by a Federal Deposit Insurance Corporation, which is backed by the full faith of the U.S. government. But FDIC insures deposit at qualifying financial institutions. Not every bank is insured by FDIC, so you should definitely check when you open an account. You should check to make sure that the institution that you chose is insured. Your money at that institution is insured through FDIC. So not every bank is insured by FDIC. You should know that the total amount insured is $250,000 per depositor, which means that you can open 5 different accounts and then thinking that each account is separately insured. That's not the case. You are insured by FDIC for a total of $250,000 per institution. You should also know, and this is very important, this is a huge misconception. FDIC insures against bank failures, meaning Bank ABC applying for a bankruptcy. That's okay. If they are FDIC insured and your money is FDIC insured, then you have nothing to worry about. But FDIC does not insure against fraud, identity theft, or even the fraud at the banking level. You're not insured at all. So this is a misconception that the FDIC provides insurance for deposit. It really does not. It offers insurance against bank failure overall. So we talked about 3 different kinds of accounts: checking accounts, which immediate access, but you're giving up safety and security; savings account, slightly safer, um, and you still have immediate access, but you're not writing checks against it, but you could also have a debit card connected to it; and a certificate of deposit, which is definitely not an immediate access. It is a long-term investment account in a way. You're renting your money out to the financial institution, and you lose the usage of your money for that duration. But people neglect to check these accounts a lot of the time, since they're thinking the money is actually locked up for the next 5 years, so I don't really need to check it. And that makes it vulnerable to fraud and theft and etc. So other than these 3 accounts, in a separate presentation, we'll talk about brokerage accounts, and that's about it for the bank accounts. So thank you.